The crypto market just crossed $4 trillion. Bitcoin's at $109,000. But the story isn't the price. It's what this milestone means for your portfolio allocation, whether you hold crypto or not. In the next 9 minutes, I'll walk you through 5 institutional trends, the risk framework Wall Street is using, and a strategic approach you can implement. This isn't financial advice. I'm not your advisor. But if you manage your own capital, understanding these structural shifts matters. Let's decode the 4 trillion. First trend. Institutional adoption is no longer theoretical. It's in production. And it's systematic. $4 trillion. Context. That exceeds Germany's GDP and represents 15% of U.S. equity market capitalization. 70% of 2024 inflows. Institutional capital, pension funds, endowments, family offices. Bitcoin spot ETFs absorbed $35 billion in their first year. BlackRock's iShares Bitcoin Trust reached $10 billion in assets faster than any ETF in history. Not ESG funds, not tech, Bitcoin. That's structural change, not speculation. What shifted? 2 catalysts. First, regulatory clarity. SEC ETF approval ended a decade-long prohibition for fiduciaries. Second, institutional custody infrastructure. State Street offers crypto custody. Fidelity Digital Assets carries Lloyd's of London insurance in the hundreds of millions. When trillion-dollar fund managers see risk mitigation, capital deploys. The playbook emerging, 1 to 5% Bitcoin allocation, treated as uncorrelated asymmetry. Not speculative positioning, portfolio diversification. Bitwise's 2025 advisor survey indicates 40% of financial advisors are evaluating crypto exposure for client portfolios. Takeaway: ignore short-term price action. Watch infrastructure development. When Wisconsin's state pension allocates $160 million to Bitcoin ETFs, that's institutional normalization. Second trend: real-world asset tokenization. U.S. Treasuries, bonds, and real estate on blockchain. Ondo Finance, $200 million in tokenized treasuries at 5.1% APY. Treasury yield with 24/7 liquidity, fractional ownership, no minimums or lockups. BlackRock launched BUIDL, tokenized money market fund on Ethereum. Franklin Templeton's fund holds $400 million. These are flagship products from trillion-dollar managers. Why it matters. Tokenized fixed income beats sweep accounts. Reallocation happens instantly, not T+2 settlement. Circle, $34 billion USDC issuer, uses tokenized treasuries. That's confidence in blockchain settlement. BCG estimates $16 trillion tokenized asset market by 2030. Current penetration, under 1%. This bridges legacy finance and crypto. Third trend. Infrastructure is built. Layer 2 networks, cross-chain bridges, institutional rails. Context: Ethereum fees hit $50 plus in 2021. Today, Arbitrum and Optimism cost pennies while maintaining security. Coinbase's Base processes 2 million daily transactions. Visa tests USDC on Solana. For $500 million trades, speed and cost matter. 3 breakthroughs. Ethereum's Denkun cut layer 2 costs 10 times. Account abstraction eliminated seed phrase risks. Fireblocks connects banks to DeFi directly. Smart contract risks exist, but audited protocols with insurance are standard. JP Morgan runs blockchain settlements in production. Thesis: infrastructure tokens with institutional adoption are the picks and shovels play. Fourth trend: Bitcoin shifts from speculation to strategic reserve. MicroStrategy, $40 billion market cap, issues debt to buy Bitcoin as treasury policy. El Salvador made Bitcoin legal tender. Bhutan mines Bitcoin as national infrastructure. State-level strategic decisions. The math: 21 million Bitcoin cap. 8B people. If 1% of global wealth, $4 trillion, moves to Bitcoin as a hedge, models show $500,000 per coin by 2030. Fidelity Research. Apple holds $162 billion cash at 4% yield. If S&P 500 companies put 1% in Bitcoin, That's 200 billion plus demand. Bitcoin's 30-day volatility is now lower than Tesla. Volatility compresses as institutions enter. Framework: treat Bitcoin as digital gold with tech multiplier. 5-year minimum horizon. Fifth trend: regulation evolved from threat to catalyst. Europe's MiCA provides comprehensive framework. Coinbase, Kraken, and Binance now operate with banking licenses. SEC approved Ethereum ETFs, ending 2 years of uncertainty. CFTC gets jurisdiction over digital commodities. Coinbase spent $50 million on politics. A 16Z launched a crypto POC. The industry engaged Washington and got progress. Result: lower regulatory risk. Galaxy Digital received broker-dealer licensing. Traditional finance is absorbing digital assets. Watch stablecoin legislation. If Circle gets federal charter, that unlocks 100 billion plus market overnight. Reality check: bear scenarios. Bull case: institutional flows are persistent. ETFs are permanent. RWA addresses $16 trillion market. Layer 2 solves scaling. Regulation reduces uncertainty. Bear risks. First, macro risk. If real yields hit 6%, Bitcoin acts like risk-off assets. 30 to 50% drawdowns possible. Second, leverage. 10x plus ratios in derivatives. Liquidations can erase 30% value in 48 hours, seen in 2018, 2020, 2022. Third, quantum computing could break cryptography in 10 to 20 years. Protocol upgrades needed. Fourth, regulatory reversal. Self-custody restrictions or unrealized gains taxes create headwinds. Risk management. Institutions. 1 to 5% allocation, quarterly rebalance. Retail. 5-year plus capital only. Dollar cost average, no leverage. Diversification. 60% BTC/ETH, 20% RWA, 10% infrastructure, 10% select ops. Avoid memes. Not advice, institutional frameworks. View: A. Add BTC/ETHB. Explore RWASC. Weight lower D. Stay traditional. Best comment: Featured Plus signed 2025 RWA report, 20-page research. Link pinned. Valuable? Subscribe weekly dives. Notify Friday Reggies. Reminder: high-risk crypto. Consult professionals. Education only.